Righto guys, so this here is Bob, our builder. He's been a builder for 15 years and 5 years ago he decided to go into business. Now he's been doing really, really well and has built up his business to a team of 6. He is so busy on the tools that he just figured that someone would let him know what's going on in his business. So he trusted his accountant, his bookkeeper, to let him know what was going on. He's just had a meeting with his accountant at the end of the year and has been given a $57,000 tax bill and no money to pay it. Now he made a profit of $210,000 and only has $9,000 in the bank. So he feels like he's working harder than ever, but he still feels broke. Now this is really common and something that we see with a lot of business owners, that quite often you go into business, but no one ever teaches you how to run a business and some of the fundamentals. So we're going to go through some of those today.
All right, so what we're going to cover off on, we're going to explain the difference between profit and cash flow because they are very, very different things and vastly different for a lot of businesses. And if you know what one is and not the other one, you can run into real challenges and a lot of confusion. We're going to give you 4 ways to improve profits. Believe it or not, there is only 4 ways that you can do that. There's lots of nuances in those 4 ways, but there's only 4 ways you can do it. We're going to give you 4 levers you can pull to manage your cash flow as well. Teach you to spot some of the warning signs of a cash flow crunch before it hits so that you can make some changes. And we're going to give you some practical tips and obviously a workbook to refer to with some things you can use in there and tools to take away and implement in your business.
Now, if you see that pink dot, there is something to download in your workbook. So throughout the presentation, you'll be seeing those at some point in time.
So is anyone brave enough? Can anyone give other than the accountants in the room, can anyone give a definition as to what, other than what you earn, what profit is, what their understanding of what profit is? So what profit is what you invoice, income that you invoice out. So you haven't necessarily, the distinction there is you haven't collected the money yet, and bills you've received and incurred, but you haven't paid yet. So in reality, you can run a business for a period of time, invoice a whole heap of income out for work you've done or for things you've sold, receive a whole heap of bills for things you've bought or for contractors or whatever you like, and not have paid a cent out or received a cent, and still have a profit and loss statement with numbers on it. Okay, so that's got nothing to do with cash coming in the door. Profit's purely to do with the actions you've undertaken from running the business. Cash flow, which is the really key thing, is when that money comes in and then when the money goes out to pay the bills. And that's where you get caught. That's the challenging bit, is managing that part of it, because that's all to do with timing. You can't control it a lot of the time, because if we could control when people paid us, it would make business a hell of a lot easier, but we can't. We can only ask and provide terms and then try to enforce those terms. And then we've got to manage it on the way out as well, along with things like growth and other challenges that come with being in business. So a significant difference. Now what we will say is that you can have a profitable business with no cash flow. That's very possible. You cannot have a not profitable business with any sort of cash flow. If your business is not profitable, you absolutely won't have cash flow. So we've got to start with our profit. That's the starting point.
So we just want to regroup back to Bob. Where did his $210,000 worth of profit go? Because as Joe just explained, the profit is your income less your expenses. And quite often we see people at the end of the year and they go, but I don't have $210,000 worth of cash. So where's it gone? So for Bob, $30,000 of that is still outstanding from his customers. $50,000 he took out of the bank and bought a new ute with cash. He's taken $110,000 drawings for himself as a wage. He has $15,000 in loan repayments that he's made throughout the year and an extra $5,000 in the bank account. So you can see very quickly there's not a lot left once all of the loans and debtors and assets have been taken into account. So that's kind of the difference between where the profit is, what profit you've made and where it's actually gone.
Just on that, I think one of the key misunderstandings that we see that causes issues with tax and with profit is drawings, and not realising that effectively that $110,000 that Bob's pulled out here, there's been no tax paid on that. If you're an employee and you're being paid by your employer, there's tax being taken out all the time. any drawings you're taking out of a business, out of a payroll type system, there's no tax being paid. So it's got to get paid at some stage. And people think that's an expense. It's not an expense to your business. It's just you using the money that you've made, using the profit you've made to fund your lifestyle. So that's going to get taxed, and that's quite often where most of the issue is with. And it's not an issue, but you've taken the money, you've used it, but the tax has got to be paid. So that's quite often the challenge. So profit fuels your ability to pay bills, grow, and breathe, and that's why it's so important to have a profitable. Sounds obvious, really important to have a really profitable business where it's generating good profit as well as cash flow, because without that, you can't sit back. You're constantly under the pump with having to work out how you're going to pay your bills, how you're going to collect your money. So being able to sit back and work out how you're going to improve your business, grow it, all those sort of things, it becomes very difficult. Okay, so I said before, there is really only four ways to increase profit. When you cut it down to the real important details, there's only four ways to do it. And quite often a combination of these four things is what we talk to business owners about, but there is only these four. So we'll step through them. The most obvious one is increase your price. Now that's a pretty easy thing to say. We just bump our prices up and leave everything else the same. We'll have more money at the end of the day. That's pretty common sense. But it's obviously not an easy and straightforward thing to do. And it can come with a lot of concern from business owners. And obviously, if you're in highly competitive or price-sensitive industries, it's not a simple thing to do. But what I would say, and Tam can sort of disagree or agree here, is that I would say most businesses we talk to and see, when I say most, I'd say 70 or 80% of businesses we see would be underpriced in some way, shape or form. Some by a lot and some by a little bit.
Would you agree? Yeah, definitely. Yep. Well, we're going to touch on that in the next couple of slides, for sure.
Yep.
The next one is to increase your volume. So do more things, sell more or do more services, because that will impact your bottom line just as much as what raising prices would.
Reducing direct costs. Now, this comes in a couple of ways. It's either reducing the amount you're paying for what you're selling. And when we're talking about what we're selling, that's not just an item like a chair or a table or something like that. It might be labour. When I say reducing the cost of labour, it's not paying your staff less. It's increasing the efficiency by which you complete a project or do some work. So doing the same job faster, effectively.
And the last one is cutting your overhead. So reviewing those expenses that go through your business and reducing those. Now, interestingly enough, that is the first place that people go, and it's the least bang for buck of the four. So you're increasing prices, volume, and reducing your direct cost. They have got the scalability of going over all of your different transactions. If you cut your overheads by 10%, you're only making that really small change. So it's actually not going to hit your bottom line as effectively as the first three.
And what we would tend to do, again, working with clients, is that it's not a one-size-fits-all. Sometimes it's a really obvious thing when we step through this and say, yep, well, that's where we've got to start. But it might be something along the lines of we look to increase prices a little bit in certain areas of the business where we can. We're obviously, they might be working with someone to help them with marketing or sales to grow the volume. Looking at efficiency and how we improve their workflow or stock holdings or things like that to reduce that direct cost. And the cutting overhead. So whilst Tim said that it's minimal impact, we're not saying ignore it. It's absolutely something you should be looking at, but it's not the be all and end all, and it's certainly not something that's going to save a business that's really struggling. It's just something to be more aware of than anything else.
So we wanted to just touch on the employee cost awareness, because this is something when we go through it with businesses, no one really understands or has really been stepped through this as they've gone on their business journey. So your employee costs are often not what they seem. Often when we speak to small business owners, they when we say what does your wage cost you per week, and they will tell us what the net amount that comes out of their bank is. Now that has tax withheld and super and other on costs such as work cover on top of that they often forget about. Now, if we just look at a really simple example of a full-time employee on $75,000 or $1,450 per week, the super on that's $174, work cover $44, and long service leave, whether you pay it depending on your industry, Some industries have to actually pay it at the end of a quarter. Some people are accruing it. So we like to take that into account. So the long service leave is $40 a week. So the total cost per week is not the $1,450, it's the $1,708, or an annual cost of $88,820. Even though you pay staff for 52 weeks of the year, by the time you take out your public holidays, annual leave and sick leave, they actually only work 44 weeks of the year. So when you divide that annual cost by the time that they're actually working, it actually bumps it up for when they're actually there doing the job. Now, so instead of paying $1,450 per week, they're essentially costing you $2,020 for every week that they're physically there working. Now, as Joe said before, when we were talking about reducing direct costs and doing things more effectively, we all know that employees do not work 100% of the time that they are in their work hours. They're not 100% productive. They have breaks, they have lunch, they have phone calls, they have to pack utes and unpack utes at the start of the day and set up those sorts of things. So there is absolutely no way that they are 100% productive. When we work with most businesses, productivity is something that no one tracks, and it's a really big hidden cost of a business. So let's say someone's working 40 hours a week, but only 30 of those are chargeable because there's 10 hours of staff meetings and everything else that I've just gone through. So they are only generating 30 hours of chargeable time per week. That means that they're only 75% productive. Now, when you factor that into the calculation, it ends up being $2,690 per week that they are costing you, that you could potentially charge out to your clients, instead of the $1,450, which is their gross salary. And a lot of people aren't educated on that true cost to the business. Now, if you are a service-based business that actually charges time out, then that cost alone is $90 per hour. That hasn't taken into account overheads, which go on top of that you would then have to go and charge your clients out and be making no money. When we start working with people, quite often their charge rates are 75, 80, and they're actually making a loss per hour because they think it's back to, oh, we're only paying our staff $35 an hour, so we're making heaps of money on the 90. But as you can see, that's not the case when you account for the on costs, when they're actually there, and their productivity.
And that's just coming back to that story quickly, Tam. That is really easy to see in businesses that sell time, so service-based businesses, because obviously you know what your team getting charged out at. You're charging per hour. It applies to all businesses though. Like, I'm sure we've all been to pubs or restaurants or retail stores and they've got staff running around everywhere. It's got to do with staff load. So if 2 or 3 people can manage a shift as opposed to 4 or 5 or 5 or 6, it's the same sort of thing here. You're not measuring productive time on who's making a coffee or running meals around or anything like that, obviously, but same concept. If you've got too many team members on, it's costing you too much for the amount of income you're producing. So just being mindful of that.
Now, in your workbooks, we've actually got a calculator that you can go and put your numbers in yourselves and actually figure out what one of your staff is costing you on the ground in your business.
It's a QR code. It's an Excel worksheet.
Excel spreadsheet. Yep.
So have a play with that. If you can, we should have said this at the start. Whenever we run these presentations, we always say if you can take one thing away from a presentation and implement it, that's a great thing. We're going to cover off. We've already covered off a number of concepts. We're going to cover off a lot more. But we all know, going back into business day to day, it's very hard to implement even one thing. So if you can take one thing away from this and just focus on doing that, that's great. And our suggestion would be, and we were talking about this last night, I think this is the single biggest tip if we can have business owners when they start or before they get into any sort of challenges when they're growing. Our single biggest tip that you can implement is to have a tax bank account. Create a second bank account and move money from your operating account into that for future liabilities. We're going to touch on in a minute the impact of a tax bill coming and smacking you in the back of the head when you're not expecting it. And if you can be putting aside that money as you go through, and we're talking about things like withholding tax. Tam mentioned before, when you pay your team, you're only paying the net amount out of your bank account. You've got super and withholding tax, which is going to get you later. And it's very easy to forget about that. If you can transfer that at that point in time, and you know it's in a separate account away from your operating funds, you can be in a position where at the end of a quarter, you get your BAS bill and you just pay it, as opposed to trying to find that money. So we'll touch on that in a minute, but I think if you do that one thing, and then you extend it to GST and income tax as well as the business grows, that will mean that the money you've got in the operating account is largely yours. You're not trying to make a decision about, okay, well, if we spend this money, are we going to have enough to pay the BAS in 2 months' time? So cash in the bank gives you confidence, and confident business owners make better decisions. I think similar to the profit thing, we're all about trying to build up a nice reserve of cash in the bank. It allows you to take advantage of opportunities to grow your business and all that sort of. You need cash in the bank to grow your business quite often. And it makes you confident. It removes that worry, that sort of mental load from having to think about, okay, well, can we pay our bills? Can we pay wages at the end of a week? If we know that that's covered, well, all of a sudden you can start to focus on things that are not right here in front of you, which is powerful.
So as we went through earlier, we've got the profit. So we've kind of gone through those 4 ways that you can increase profit. And now we've kind of segued into how that is going to impact your cash flow and what you can do. So the biggest cash flow killers that we see are, one, that compliance catches you off guard. So as Joe said, at the end of a quarter, quite often people don't have the money aside for their BAS. Then that ATO debt starts to creep up on them. The income tax at the end of the year, just like Bob, they don't have that aside. So those sorts of tax compliance is a really big one that kills cash flow. And if you're putting that aside in another bank account, you then can see the earlier warning signs of a business struggling without realising it. Because sometimes if it's all in the one bucket, you can't see those things because you're using money that's not yours.
You're effectively borrowing from your future self, which you have no plan to pay back, which is, challenging.
Overcommitting on assets or loans. So, getting a new vehicle and not really taking into consideration the impact of that, because we might need it for the business or we might need to upgrade it, but we're not really taking into consideration the impact that those extra repayments are going to have on cash flow. Slow or forgetting invoicing. So just getting too busy and not getting your bills done at the end of the month, or taking a couple of weeks from when you do a job to actually get it done, or forgetting some. We see that a lot as well. Just literally a business is running too hot and they forget to send some invoices.
I was talking to a new client on Tuesday and they were saying that they had, just from the last 6 months, about $150,000 that they'd gone through and worked out that $150,000 of invoices they hadn't sent yet. In $1 million, like a business turning over about $1 million a year. So it sounds really obvious, but it's a really common one, absolutely.
And as Joe said before, drawing too much from the business personally. So not actually having a plan there, thinking that the business is doing great because you got some money in the bank account, but if you're not quite understanding your numbers or you don't really know where you're at, then quite often people are drawing too much from their business for personal use. And that's another thing that's going to drain your cash flow. So what are some of the red flags that we see? So if you can notice that your profit is dropping from month to month, that your cash in the bank is decreasing from month to month, that customers are taking you longer to pay, that you can't pay your tax at the end of the quarter, like your BAS, or end of year compliance, or your suppliers, you're starting to kind of get really tight at the end of a month, and have to kind of start to pick and choose who you're paying. Stress about paying wages. I think that's a really common one for a lot of business owners, making sure that you're going to have that 20 or 30, 40 grand in the bank account at the end of the week to pay wages. If you're having to put personal funds in or stop drawing your own wage. Now, they are signals, and if you don't kind of listen to what your business is trying to tell you or what your cash flow is telling you, ignoring them is just going to delay the crash and make it bigger.
Now, not to normalise that too much, but what we would also say is that these things are not uncommon at all. Like every business will experience something like these. from time to time. So it doesn't mean that your business is going poorly or that it's failing or anything like that. It's more so just as Tam said, a warning sign to put your hand up and start to talk to your advisor. This is why we talk to clients fairly regularly, because these things happen, they pop up, and if we know about it and we're in front of it, we can do something about it. If we don't, then it's very difficult. It gets to a point where you can't change the outcome, and you've just got to accept what's happening, which is not a good spot to be in.
The other thing is as well, not even, even if you don't talk to an advisor, it's just you being aware yourself, because quite often we are really busy and we can tend to kind of bury our head in the sand because it probably means that there's some hard things that we need to do to fix that. So it's that self-awareness as well.
So what are the levers we can pull? And there's other ones, but again, these are the four ones we quite often talk to clients about around trying to speed cash flow up and get that moving. And again, I'll preface this by saying that we always start with the profit. If you haven't got the profit right and the numbers aren't right, your model's not working, you're not going to be in a position where there's going to be cash flowing through at some point in time. You've got to have the profit bit right first. So the first thing is speeding up receivables. So that involves making sure we've got an appropriate and timely invoicing process, and that the invoices are getting out, that we're making sure that if we've got jobs that are dragging out for a period of time, like projects or larger jobs, that we're interim billing that. We're not waiting till the end to try and bill all of it at the end, if we can do that. And also your collection process for actually getting the money in once the invoices have gone out. Not allowing, having appropriate credit terms, enforcing those credit terms, not allowing people to take the mickey and use you as a bank, because effectively that's what they'll do if you allow that to occur, and making sure that all those things are in place to speed that up. So it means that we talk about a cash flow cycle, which is that the amount of time it takes you to do a job and get paid and get the money in the bank. We're making that as short as possible. And we tighten our outflows management. That includes expenses and looking at overheads and all of that sort of stuff that we spoke about before, but it also means looking at the amount you're paying out for debt, for borrowing. Is that appropriate? Can the business deal with that? Do we have to make some decisions around getting rid of some assets, which is another one of the points there. Monitoring inventory and WIP, that's a massive one. Inventory or stock on hand is a huge cash suck for businesses, because it's basically cash sitting on the shelves. Now you need the stock to sell it, obviously, but if you're not monitoring that and you're not keeping an eye on what's turning over, it can mean that cash is sitting on the shelves for a long period of time, which is just stuck there and not doing you any good. And obviously the longer something sits on the shelf, the less likelihood you're going to be able to realise a good value for it as well. You might have to sell it or put it on sale to get rid of it, which means your profit shrinks down. And selling down or monetising lazy assets, again, that sounds like a really simple one that people, if you've got an excavator or a tractor or a truck or something sitting around, you'd notice it. You think you'd notice it. Well, it's not always that obvious that that's the case, and they don't need to be sitting around doing nothing. They've just got to be doing not enough work to cover the cost of having them. And we see that a lot. And again, that some of that's just due to convenience and the ability to do things when you need to do them and all that sort of stuff. But if it's hurting your business cash flow wise, then it's probably worthwhile looking at freeing that up.
In your books, there's what we call a link to another Excel spreadsheet called a cash flow break even. Now, this is how much money you need to generate each year or each month to not go broke. And it's for you to be able to, again, implement or input your business figures in there to actually find out what your cash flow break even is. Now, most break evens don't actually, they just look at profit and loss. They don't look at the cash flow side of things. So this is one that Joe and I have developed. And I wanted to just show you the difference between a normal break even that someone might give you and then a cash flow break even. So this business here turns over 1.5 mil with a 40% cost of goods sold. Their and $450,000 worth of overheads. Their break even sales is 1.1 mil or $92,000 per month. However, that is only taking into account the business's income and expenses, not the loans and the drawings that you take out afterwards that are actually going to impact your cash flow. So to make sure that you're not dipping into cash flow reserves and that you're not going to be going backwards as a business, we like to take into account the loan repayments and the drawings that you're going to, that you have to take out. When we put those into the spreadsheet, you will see that the break-even sales to just have no cash flow growth or like no cash reserve, so just money coming in, money going out equals zero, or is the same amount, is nearly 1.8 mil or $150,000 a month. So that's a $52,000 difference between what you need for cash flow and what the profit and loss break even would be. Really, really big difference. And I think it's a really key thing that you need to know in your business. So make sure that you go and fill that in your workbook. So why is knowing that important? So knowing that cash flow break even will give you peace of mind. It will help you sleep at night. A lot of businesses that we talk to, they're up all night stressing about money. If you know what you need to be generating each month, then you've got that peace of mind figure. It will help you set sales targets and, again, know what you need to be doing to be able to get the correct amount of cash flow in. Because
obviously that amount there is purely just to have $0 left at the end of the period of time, which is not ideal. We probably want to do a bit more than that. So it allows you to plan to say, well, if we want to have drawings of X and we've got our loans and all that sort of stuff, and we want to have a little bit more in the bank, again, that number's going to be higher again.
We need to be $200,000 a month.
Yeah, and then then your strategy is built around how do we generate that sort of income and make that sort of profit.
It will help you make key business decisions. So when you go to buy a new asset, do you really need to? Because that's going to impact that. So again, having that personal awareness in your business of what that looks like. It will help also if you're putting on new staff and those sorts of things to actually see what the impact will be. It will help you plan for cash flow ups and downs, because I know that anyone in business knows that you're not going to have exactly the same amount of sales every month. Things fluctuate, seasons happen, cash flow is never, constant, but it will help you be able to plan for that and know that you may have a low cash flow month coming up, but then you know that there might be another high one coming, so it's all going to be okay. And it will help you with risk mitigation. If you notice that there's a few months in a row that we're not hitting that target, then you will know that there's a problem that we need to address. So again, it's to give you that awareness as well. So back to Bob from the start, what would we have done different? So there's actually not too much that we would have told Bob to do different. There's probably 2 or 3 key things. One is we would have absolutely told him to finance that ute. Don't take the cash out of a business. As Joe said before, cash is king. And I know everyone's heard that, but it genuinely is true in business. You need that money in the bank account to be able to float the income and expenses, for your business. So we would have told him to not pay cash for the ute. We would have told him to look at his collections. So try and collect the money from customers a little bit quicker. And then the only other one we would have suggested, and it depends on his structure and that sort of thing, we would have looked at that drawings and seen if we really need to be taking that much out, or educate him on the impact of doing so. So you can see that if we had the 50 grand in the bank account and we may have collected a little bit more money quicker and maybe not taken a lot of drawings, he would have absolutely had more than enough money to pay that tax bill and wouldn't have been so worried at the end of the year. So it's about that awareness and making those small little changes and knowing the impact of your decisions throughout the year.
And probably the only other thing there is just coming back to that putting tax money aside, just being mindful that we'd be catching up with Bob fairly regularly on a quarterly basis and saying to him, well, we can see your profit is X and it's sort of grown over the year. We know you're going to have a tax bill of sort of circa $50,000, $60,000. So if we can be putting aside $10,000 or $15,000 a quarter, again into that separate bank account, he finds he's got less money in the bank during the year in his operating bank account, but he's fine covered off with the bill at the end of the year. It would also probably drive him to not be able to buy that ute out of cash. Now that sounds like a silly example, but it's not. It happens a lot where people, and it's not always a ute, sometimes it's a large lump sum of stock or whatever it might be, that it just really eats a hole in that cash flow. And if he's putting that money aside, well, he hasn't got 50 grand in the bank to go and just spend on a ute. He's got to, if he wants to buy a vehicle or something, he's got to fund it.
So some of our tips. Making sure that you are scheduling time every month to be looking at your profit and loss and your balance sheet. So these are reports that, you know, if you have Xero or MyOb or QuickBooks, you can access those at any point in time. So making sure that you're actually spending the time looking at your numbers. Knowing what the key measures are in your business. Every different type of business has different things that they need to be focusing on. So educating yourself on what they are for you. If you're not quite sure, come and see us afterwards and we can talk to you. Knowing what that cash flow break-even point is so that you have that awareness of what you need to be aiming for, or you can help, I suppose, just educate yourself and have that peace of mind. That all of those things will help you to make better, more informed decisions as you're going through business the day-to-day. When you notice some of those red flags, make sure that you take action. Don't bury your head in the sand. Don't think that it's going to go away, because these things don't. They just compound if we don't address the root cause of it. And continue to always educate yourself. Ask your advisors, get them to explain, where is your money gone? Why have I got a profit? Why have I not, got the money there? Those sorts of things. If you don't have the right people around you, go and find someone that can educate you on those sorts of things. But thank you so much to Karen and the Shepparton Council for inviting us up here to speak today and have a bit of a chat to you. I hope that you guys have all got something out of today that you can take away and implement into your businesses. So thank you very much for coming.
Thanks.